2016 has been another good year for Tarsus. The drivers of the strong operational performance have really come from the three key pillars of our strategy, quickening the pace. Firstly, the organic growth coming through in the business. Revenues are up 8%. Our buyer growth, which is the lead indicator of the strength of the events, is up 7%. Also, we've carried on our replication program where we've launched 10 new events during the year. And also we have made 4 key acquisitions to accelerate that growth, 1 in the US, 2 in China, and 1 in Southeast Asia. It was a busy year in terms of acquisitions for us, where we've made 4 acquisitions, 1 in the US, 2 in China, and 1 in Southeast Asia. We continue to focus the business very much about markets in transition, and we had the opportunity in the fourth quarter to really scale our business in the US when we bought a business called Connect, which is focused on the meetings industry, where buyers and sellers come together to put on the meeting schedules for the following year or subsequent years. Secondly, we've made 2 acquisitions in China, where we've got scale in the business now, and overall the US and China now account for 2/3 of our business, and those are the 2 largest exhibition markets in the world. So we now have real scale in those 2 key markets.
2016 was a very good year for us financially. The even years are quieter for us. Our large biennial shows take place in the odd years. We had a good underlying organic growth, our revenues up 8% on a like-for-like basis on constant currencies. In terms of foreign currency, post-Brexit, sterling was weaker and that created currency tailwinds for us, and we had a 13% benefit overall versus 2015. But it's that strong underlying growth that's important for us, and the revenues up on 8% flow through nicely into earnings and profits and allowed us to increase our dividend again by 8% this year to 9.1 pence per share. It was a busy year for us on corporate activity. We paid a number of earn-outs relating to previous year acquisitions. We bought the minority shares from 3 of our joint ventures, and we had 3 acquisitions: PEP in the Philippines, Intex in China, and at the end of the year, Connect in the USA. To part fund the Connect acquisition, we're grateful for the support of our shareholders. We raised £23 million with a placing. Our bank facilities have increased to £111 million, and they extend out to 2020. The main commercial terms are the same as they have been in previous deals, the main one being our gearing covenant at 3 times net debt to EBITDA. Now, with all the corporate activity, our net debt was £69.5 million at the end of the year. That's geared at 2.2 times. That's above our long-term range, 1.5 to 2 times. We will go above that for a short period as long as we see a path back down to within range fairly quickly. Now, whilst our gearing will increase slightly during the first half of this year, it'll be back down within range by the end of 2017.
The outlook for 2017 is positive. It's early in the year, but we've got off to a good start. 2017, we benefit from the occurrence of the 2 big biennial events, Label Expo Europe and the Dubai Air Show, and those big biennial engines are performing well. In the US, the investment we've made in our medical business is coming through, and our newly acquired Connect business has also got off to a good start. Asia continues to do well for us, and we've had a good first quarter. And overall, the business has good momentum, and that scale of the business is really kicking in.